Welcome to Manifested Publishers.
Our esteemed learner, welcome once more to our discussions. Still in topic number 2, the forward markets and contracts, we have been able to see that and understand that the type of forward contract depends on the type of underlying instrument or the assets. So we said that there are predominantly 4 underlying assets that are used in derivative: the stocks, the bonds, the exchange rates, and the interest rates. From there on, we have been able to derive the various types of forward contract based on the underlying. And also there is another category, 5 category, which we call others, either the weather, the climate, or even the commodities. So in our previous learnings also, we have been able to see that the stocks or equity drive what we call the equity forward contract based on 3 categories: the individual stocks. The second category is also the stock portfolios and also the stock indices. On bonds, now we have the bonds and also the bond portfolios and also the forward currency contracts. Our lesson today, we will try and see and understand the category on bonds and also the category on the forward currency contract. So let us see the bonds and bond portfolio. Forward contracts on bonds and bond portfolios. So we start by reminding ourselves again, we covered it elsewhere, that bonds are agreement or commitment between the issuer, who is the borrower, to pay to the investor, who is the bondholder, the principal sum, the principal sum, we call it the par value, and interest on agreed timelines. So that is the bond, refreshing our minds on bonds, that the agreement between the borrower to pay the investor, the bondholder, the principal, value, par value and interest on timely agreed basis. Therefore, as far as now the forward contracts are concerned, we say that the bonds and stocks are similar. The forward contract of bond and forward contracts on bond and stocks are similar. They operate in a similar way in that they vary or they drive the value from the underlying. We can see this because they have underlying cash flows. In that now the bonds pay interest. They pay interest or coupon, every 6 months, for example, right? And also equity, they pay what? Dividends. They pay dividends. However, there are differences, isn't it? There are differences from bonds. There are differences. Or differences of forward contract of bonds, forward contract on bonds and equity. One difference is that a bond matures. So one difference is that a bond has maturity. Maybe a bond will go for a period of 1 year. A bond will go for a period of 2 years or 5 years. So it has maturity. But you find that equity is on perpetuity. equity is perpetuity. Perpetuity. So unless the company is winding up, the common stock of the equity of the company will outstand unless maybe the company is being wound up. So therefore, the forward contract on the bond must mature. The forward contract of the bond must mature before the bond's maturity. Forward contract on bond must mature before maturity of the bond. Mature before bond's maturity. The second difference that we get is that the special features. Bonds have special features. Special features, yeah. These special features included in the bond contract could be what we call embedded options. The embedded options. Now, embedded options, there are additional contracts that can be included in the bond contract. For example, we could have the call option. So this entitles the issuer to pay back, yeah, to pay back the issue before maturity. Before maturity. So what happens with a call option is that the issuer, who is the borrower, in the cases of declining market interest rates, isn't it? Assuming that he had borrowed a bond at maybe a prevailing market rate of 16%, but now the market rate declined to maybe 12%. Now, when that bond indenture, we normally call it the contract, as an option of call option, now the issuer, yeah, the borrower, can retire the bond, yeah, before its maturity, because it can be able to re-enter the market and borrow at maybe 12%, that is the decline rate, and save on high cost of borrowing. Now, there is also conversion. Conversion, we find that the bonds can be converted from a bond, which is a debt instrument, to equity, depending on what favors the bond holder. So the contract, the bond contract, or the bond indenture, can have a provision, yeah, among that contract that grants the right to the bondholder to convert this bond into equity. And we find that this conversion is to convert into equity of the issuer. Equity of issuer. So therefore, with those special features, mostly the embedded options, then the bond forward contract and equity forward contract will differ. The third difference between the forward contract on bonds and forward contract on equity is that bonds can default. Bonds can default. Bonds can default. What we find that is that the contract, the bond contract, must able to have a distinction. So within the bond contract, we should be able to define what default is. Define what default is. Because we said that forward contract, these forward contracts are customized. So agreement in the meaning of default may change from one party to the other. So within the bond forward contract, they must be able to define what default is and how that default affects the parties. How default affects the parties. So how default affect one party, yeah, party A, party B, might not be what affects maybe party B with party D. So if there are variation, if there are circumstances that are desirable to them, then that default will be defined differently. So those are the differences between the forward contract on bonds and forward contract on equity. So forward contracts, so we can also see that the forward contract on bonds can also be on individual bonds, and they can also be forward contract on bond indices. So this is so similar in the way we found that the equity forward contract can be on individual stocks and also stock indices. Bonds for forward contract are how do we then proceed having that understanding for bonds on forward contract? So the forward contract on bonds, forward contracts on bonds. The forward contract on bonds, we must make these assumptions. And the first assumption is that they are mostly, in most time, based on the default-free zero coupon. They are based on default-free zero coupon treasury bills. Commonly abbreviated as the T-bills. So we normally do our discussion on forward contract on bonds based on the default-free zero coupon treasury bills. So this one, they serve as a proxy. Of the risk-free rate, So we say that at least with the word risk-free rate, we are trying to minimize on the extended effect of default. So that's why in our analysis, as far as we are looking on the forward contract on bonds, we fall for the T-bills. Now, let us look and what happens to these T-bills. Let's analyze them further, the T-bills. Now, the treasury bills, we find that they are sold at a discount from par, sold at a discount from par. What do we mean when we say that bonds then are sold at a discount from par? What we normally say is that price is quoted at a discount rate. Price is quoted at a discount rate. What do we mean price is quoted at the discount rate? To get this understanding, let's have an example. For example, let's say we have a discount rate. Let's say we have a discount rate of, say, 4%. And we know that rates are, in finance, we have had the understanding that rates are quoted annually. So this is 4% per annum. This is 4% per annum. Let's say, for example, a 4% for Kenya shillings 100 per. Kenya shillings 100 per that matures maybe in 6 months. Then how will we determine the price? So we determine the price using what we call the discount interest. Now, how do we proceed using the discount interest? Now, normally we said that T-bills are issued at a discount, and at maturity, the par value is paid. For example, if you had a T-bill of 98, maybe for 6 months, you will find that at 98 is the price that you give the government. You wait for 6 months, and the government pays you back at 100 par value. So these two prices means that the security price was still trading at a discount less than the par value of 100. So normally now what we do in determine this price at 4% and Kenya shilling 6 per 6 months, the price will be determined by the par value of 100, the par value of 100 minus now two things. First of all, 4%, yeah, which is equals to 0.04. 4% is equal to 0.04. Now, rates are quoted annually, and in 6 months, we say those are half an year of 180 days over 360 days, the number of days available in a year, maybe times now the par of 100, times now the par of 100. So you will find out that this will be is equals to 100 minus 0.04 times 180 divided by 360 times 100. This gives me 2. So this is minus 2 to give me a price of 98 for 6 months, 98. Yeah. So this will be the price the instrument will sell. It will sell for 98, such that when it matures, the issuer, yeah, issuer pays 100. So we say in T-bills, they are normally quoted at a discount interest or at a discount rate and not the price. So we are saying that T-bills, these treasury bills, will be quoted at a discount rate, and not the price, price. We also find that the understood discount rate can be computed into the price. We find that the market participant, when they get the discount rate, it can be computed for the price. Using this formula we have used of the discount interest. Having that understanding, then it is our time now to look at the exchange rates. Now, exchange rate, we've said that it is a price of one currency, one country's currency against the price of the other country's currency. So here we say that currency forward contracts, what are they? Currency forward contracts. Now, in currency forward contract, we said that they are normally used by banks and corporations to manage, normally used by banks and corporations to manage foreign exchange rate risk. Exchange rate risk. Let's see this through an example. Let's say, for example, we have a Kenyan flower farmer, a Kenyan flower farmer farm, farming farm that has exported into the European market, European market, let's say euro 12 million. Let's say euro 12 million. And it is expected to receive this payment in 3 months' time. 3 months' time. It's expected to receive this payment into 3 months' time. So what happens at 3 months' time? This farm, because it is Kenyan by operation, it will receive euros. Okay, and convert them into Kenya shillings So the Kenyan farm will be selling euros, and the Kenyan farm will be buying the Kenya shillings. That is what we are saying. So in order to manage against the exchange rate risk, and the risk here can come from volatility. And in volatility is the probability or the chance that the exchange rate between the Kenya shilling and the euro could keep on fluctuating, isn't it? So they approach a dealer. Let's say they approach one dealer called Absa Bank. Yeah, and Absa Bank is able to agree to quote, an exchange rate maybe of Kenya shillings 125 per 1 euro. Yeah, so it will be able to quote that, and this will remain in force for the next 3 months. So this quote now is static, right? Therefore, the Kenyan farm now has at least gotten an assurity that in 3 months' time, it will be able to sell the Kenya shillings at the rate of 125 for 1 euro. Now, what happens at 3 months' time? Now, our farm will be able to, in 3 months, will approach Absa, and convert euro 12 million into Kenya shillings. So if the exchange rate at 3 months has been set at Kenya shillings 125 for every 1 euro, what about 12 million euros? So we cross multiply to give me 125 times 12 million euros to give me 1.5 billion. So the farm will be able to obtain Kenya shillings 1.5 billion. If you like, 1, 5, 1, 2, 3. Yeah. So therefore, locking in the exchange rate at 125, and therefore the farm will not be exposed to the risk of fluctuations of the currency. Having seen the similarities between equity forward contract and the differences, or to also bond forward contract, we also found out the bonds and the bond portfolios, how they trade, and the forward currency contracts, and how they can be helpful in managing the foreign exchange rate risk. We have come to the end of the lesson, of which now we must be able to give an assignment so as to see the progress of our learning. So as an assignment, assignment number one is discuss the various differences of forward contract on bonds, contract on bonds, and forward contract on equity, forward contract on equities. Assignment number two, determine the price for a treasury note, for a treasury bill – quoted at a discount rate of 4.2%, quoted at a discount rate of 4.2%, that matures in 90 days, given 360 days in a year, 360 days in a year. So for our lesson, the assignments, they are two in number. The first being discuss the various differences of forward contract on bonds and forward contract on equities. Number two, determine the price for a treasury bill quoted at a discount rate of 4.2% that matures in 90 days, given 360 days in a year. Thank you for your participation.